I've met 10 seven-figure traders in my life, and I've met many more unprofitable ones. The difference between them isn't what you think. It's not about having a better strategy, more capital, or insider information. It's not about trading specific pairs or time frames. It's not even about intelligence or education. The difference is simple, yet profound. Mindset. The unprofitable traders I've met are constantly searching for the next perfect strategy, the next indicator that will finally work, the next guru who will give them the secret. The reactive, emotional, and always looking outside themselves for answers. The seven-figure traders? They operate on a completely different frequency. They've mastered something that most people will never understand. They've transformed from prey into predators. This book isn't about chart patterns or entry signals. This is about the mental framework that separates the elite from the masses. This is about the daily habits, psychological principles, and disciplined routines that create consistent profitability. If you're reading this, you're probably tired of losing, tired of revenge trading, tired of breaking your own rules, tired of watching your account shrink while you work a job you hate to refill it. Good. That pain is your starting point. This book will show you what the 10 successful traders I've met do differently, not just in the market, but in their minds. You won't find magic formulas here. You'll find the brutal truth about what it actually takes to win. Let's begin. Chapter 1. The Predator Mindset. From Prey to Predator. In the wild, there are two types of animals, predators and prey. Prey animals are reactive. They live in constant fear, jumping at every shadow, running from every threat. Their nervous systems are designed for one thing: survival through reaction. They eat whenever food is available, not because they're hungry, but because they don't know when the next meal will come. Sound familiar? Most traders are prey. They react to every candle, jump into every breakout, chase every move. They're trading out of fear. Fear of missing out, fear of being wrong, fear of losing money. Their trading is reactive, desperate, and emotional. Predators are different. A lion doesn't chase every gazelle it sees. It watches, it waits, it conserves energy. When the perfect moment arrives, when the weak, isolated target presents itself, the lion strikes with precision and overwhelming force. One calculated move, high probability of success, then it rests again. This is how seven-figure traders operate. They are not sitting at their screens all day frantically clicking buttons. They are patient, selective, strategic. They wait for their setup, their gazelle, and when it appears, they execute without hesitation or emotion. The transformation from prey to predator is not about learning new strategies. It's about rewiring your entire approach to the market. It's about understanding that trading is not about being busy. It's about being effective. The anatomy of prey trading. Let me describe what I've observed in every single unprofitable trader I've met. They overtrade. They're into market constantly, making 10, 20, sometimes 30 trades per day. They confuse activity with progress. They believe that more trades equal more opportunities. In reality, they're just bleeding their accounts through commissions and poor risk management. They react emotionally. A loss triggers immediate revenge trading. A win creates overconfidence and reckless position sizing. Every market move triggers an emotional response, and every emotional response triggers a trading decision. This is the cycle that destroys accounts. They have no predefined plan. They enter trades based on feeling or because a candle looks bullish. Their stop losses are arbitrary. Their profit targets are based on hope, not calculation. They're essentially gambling with better graphics. They chase price. FOMO dominates their decision-making. They see a breakout and jump in at the worst possible moment, right before the retest or reversal. They buy tops and sell bottoms because they're driven by fear of missing the move. They take losses personally. When a trade goes against them, they feel like failures. They tie their self-worth to their win rate. They can't cut losses quickly because it feels like admitting defeat. So they hold losers and cut winners, the exact opposite of what works. This is prey behavior. This is reactivity. This is trading from a position of weakness. And this is why 90% of traders fail. The anatomy of predator trading. Now let me describe what every single seven-figure trader I've met does differently. They wait. Trading for them is boring most of the time. They spend hours, sometimes entire days, watching the market without taking a single position. They're not looking for something to do. They're hunting for their specific setup. When it's not there, they do nothing. They pre-commit to every decision. Before entering any trade, they've already decided entry price, stop loss, position size, profit target, and exit strategy. There is no emotional decision-making during the trade because all decisions were made beforehand in a calm, logical state. They treat losses as data, not defeat. A losing trade means nothing to them emotionally. It's simply a statistical event in a series of probabilistic outcomes. They understand that a single trade is irrelevant. What matters is the performance of their system over 100, 200, 500 trades. One loss? Irrelevant. They risk small and win big. Their risk-to-reward ratios are minimum 1 to 2, often 1 to 3 or 1 to 4. They risk 1 to 2% of their account per trade, never more. This means they can be wrong 40, 50% of the time and still be highly profitable. The math works in their favor because they designed it that way. They are comfortable with discomfort. Watching the market do nothing while waiting for your setup is uncomfortable. Sitting through drawdowns without revenge trading is uncomfortable. Taking a loss quickly without hesitation is uncomfortable. Predators have learned to embrace this discomfort. They've realized that trading success requires choosing productive pain over destructive pain. The choice you must make. Here's the brutal truth. You cannot trade like prey and expect predator results. The market is designed to extract money from emotional, reactive, undisciplined traders. It is designed to trigger your fear and greed. It is designed to make you feel like you're missing out when you're not trading. It is designed to punish impulsive decisions. If you continue to react, chase, overtrade, and trade emotionally, you will continue to lose. There is no strategy, no indicator, no guru that can save you from your own behavior. But if you commit to the transformation, if you choose to become a predator, everything changes. You stop reacting and start anticipating. You stop chasing and start positioning. You stop overtrading and start executing with precision. You stop letting emotions drive decisions and start following your predefined plan. This transformation is not easy. It requires discipline, patience, and a willingness to sit in discomfort. It requires you to go against every instinct that makes you human. The desire for instant gratification, the need to be right, the fear of missing out. But this is the only path to consistent profitability. The 10 successful traders I've met all made this same choice. They all went through the same transformation. They all had to kill the prey inside them and become something different. The question is, are you ready to make that choice? Chapter 2. The Math of Mastery. Why most traders obsess over the wrong metric. Ask an unprofitable trader what they need to succeed, and they'll say, I need a higher win rate. They believe that winning 70%, 80%, or 90% of their trades is the key to profitability. So they spend months, even years, searching for that perfect system that wins most of the time. This is a fundamental misunderstanding of how trading actually works. Win rate is a vanity metric. It feels good to be right, but being right doesn't necessarily make you profitable. Let me prove it with simple math. Trader A, 80% win rate, wins 8 out of 10 trades. Wins 8 trades times $100 equals $800. Losses, 2 trades times $500 equals negative $1,000. Net result, negative $200. Unprofitable. Trader B, 40% win rate. Wins 4 out of 10 trades. Wins 4 trades times $600 equals $2,400. Losses, 6 trades times $200 equals negative $1,200. Net result, positive $1,200. Profitable. Trader A feels good because they're right 80% of the time, but they're losing money. Trader B is wrong more often than they're right, yet they're consistently profitable. The difference? Risk-reward ratio and position sizing. The risk-reward equation. Every 7-figure trader I've met operates with a minimum risk-reward ratio of 1 to 2. Most aim for 1 to 3 or 1 to 4. This means if they risk $100, they target $200 to $400 in profit. If they risk 1%, they target 2 to 4% gain. If their stop loss is 50 pips away, their profit target is 100 to 200 pips away. This is not optional. This is mathematical necessity. When your risk reward is 1 to 3, you only need to win 25% of your trades to break even. Anything above that is pure profit. If you win 40% of your trades with 1 to 3 risk reward, you're crushing it. But if you're trading with 1 to 1 risk reward, risking $100 to make $100, you need to win more than 50% of your trades just to break even after commissions. And most traders can't consistently maintain a 50% plus win rate under real market conditions with slippage, emotions, and unexpected volatility. The math only works if your reward significantly exceeds your risk. The law of large numbers. Here's what unprofitable traders don't understand. A single trade means nothing. They take one loss and spiral into emotional chaos. They take one win and feel invincible. They judge their entire system based on the last 5 trades. This is statistically illiterate. Profitable trading is about probabilities across a large sample size. It's about what happens over 100 trades, not what happens on trade number 12. The 7-figure traders I've met think in terms of systems, not individual trades. They know their edge produces a certain win rate and average risk-reward over time. They trust the process because they've back-tested it, they've forward-tested it, and they've traded it live through thousands of executions. One losing trade? Irrelevant. It's just one data point in a massive data set. 3 losing trades in a row? Still irrelevant. Even with a 50% win rate, losing streaks of 5 to 7 trades are statistically normal. The law of large numbers protects you, but only if you survive long enough to let it work. And that brings us to the most critical concept in trading, position sizing, the difference between survival and destruction. You can have the best strategy in the world. You can have a 60% win rate with 1 to 3 risk reward. But if you risk 10% of your account on every trade, you will eventually blow up. Guaranteed. Position sizing is the glue that holds everything together. Every 7-figure trader I've met risks 1 to 2% of their account per trade. Not 5%, not 10%, certainly not 20%. Why? Because math. If you risk 10% per trade, 5 consecutive losses wipe out 40% of your account. You need a 67% gain just to get back to break even. That's an uphill battle most traders never recover from. If you risk 2% per trade, 5 consecutive losses only cost you 10%. You can recover from that. You can survive the inevitable losing streaks. You stay in the game long enough for your edge to play out across a large sample size. Position sizing is risk management, and risk management is the only thing that keeps you alive long enough to become profitable. Here's the formula every profitable trader uses. Position size equals account risk divided by distance to stop loss. Example, account size $10,000, risk per trade 2% equals $200, entry price $100, stop loss $95, distance to stop $5 per share, position size 200 divided by 5 equals 40 shares. It's that simple. You're not guessing. You're not trading the same lot size on every trade regardless of setup. You're calculating based on where your stop loss needs to be, and your stop loss should be at a logical level, below support, above resistance, not at an arbitrary distance.
The discipline to let it play out. The hardest part of the math isn't understanding it, it's having the discipline to follow it. When you're on a hot streak, every instinct will tell you to increase position size, to make the most of it. This is how traders blow up. They risk 5% instead of 2%, hit a normal losing streak, and destroy months of gains in days. When you're on a losing streak, every instinct will tell you to trade smaller or stop trading altogether. But if you've done the math, if you've tested your system, if you know your edge is real, quitting during a drawdown is the worst possible decision. The seven-figure traders I've met have unwavering faith in their math. They don't deviate from their position sizing. They don't chase losses. They don't overtrade during winning streaks. They execute their system with robotic precision because they understand the math only works if you follow it consistently across hundreds of trades. One trade means nothing. 10 trades mean nothing. But 200 trades executed with proper risk-reward and position sizing, that's when your edge becomes undeniable. That's when probability becomes profit. Master the math, trust the math, follow the math. Everything else is just noise. Chapter 3. The Seven-Figure Routine. The Myth of the Always-On Trader. There's a fantasy that successful traders spend 12 hours a day staring at charts, making split-second decisions, riding adrenaline rushes from open to close. This is Hollywood fiction. Every single seven-figure trader I've met has a structured, repetitive, almost boring routine. They're not winging it. They're not feeling the market. They're following a system that removes emotion and maximizes focus during the moments that actually matter. Professional trading is not about screen time. It's about preparation, execution, and review. The actual trading, the clicking of buttons, is the smallest part of their day. Let me show you what their routines actually look like. Morning preparation, before the market opens. The seven-figure traders I've met don't just show up when the market opens. They prepare with intention, at least 30 minutes before the first candle. Their pre-market routine. Review overnight developments. What happened in Asian and European sessions? Any major news events? Significant moves in correlated markets? They're looking for context, not predictions. Check the economic calendar. Are there high-impact news releases today? When? They mark these times and either avoid trading around them or adjust position sizes accordingly. Update their watch list. Which instruments are showing their preferred setups? Which ones are approaching key levels? They're not watching 50 pairs. They're focused on 3 to 5 high-probability candidates. Calculate position sizes in advance. For each potential trade on their watch list, they've already calculated. If I enter here, my stop goes there, which means my position size is X. No math during execution. Everything is prepared. Review their trading rules. They literally read their written rules before the session begins. This is not about memorization. It's about psychological reinforcement. They remind themselves of the plan so they don't deviate when emotions arise. This preparation takes 20 to 40 minutes. It's systematic. It's the same every single day. By the time the market opens, they're not hoping for opportunities. They're waiting for specific scenarios they've already planned for. Market hours, execution blocks. Most traders think they need to watch the market all day. The seven-figure traders I've met do the opposite. They work in focused time blocks. 9:30 to 10:30 a.m., market open observation, if trading U.S. markets. They watch the opening range. They observe how price reacts to key levels. They're gathering information, not rushing to enter. Most don't take a single trade in the first 30 minutes. 10:30 a.m. to 12 p.m., primary execution window. This is their hunting period. Their setups typically appear in this window.
They're focused, alert, and ready to execute. If their setup appears, they take it according to plan. If it doesn't, they do nothing. 12 to 2 p.m., break or analysis. Many step away completely. Some review open positions, others do completely non-trading activities, exercise, eat, rest. They understand that mental fatigue destroys decision quality. 2 to 3 p.m., secondary execution window, if applicable. Some traders have a second focus period if their strategy has afternoon setups. Others are done for the day. 3:30 to 4 p.m., position management. If they have open swing trades, they review them. If they're day trading, they're flat by now. The key insight: they're not glued to the screen for 6.5 hours. They're intensely focused for 2 to 3 hours and completely disengaged the rest of the time. This prevents burnout, overtrading, and emotional decision-making. The boring work nobody talks about: backtesting. Here's what separates the seven-figure traders from everyone else. They backtest relentlessly. Before they risk a single dollar on a new strategy or modification, they've tested it across hundreds of historical trades. They know win rate, average risk reward, maximum drawdown, performance across different market conditions.
This isn't glamorous. It's tedious. It's hours of going through charts, marking entries and exits, recording data in spreadsheets. But this is how they build unshakable confidence in their system. When they're in a drawdown, they don't panic. They've already seen this scenario in backtesting. They know it's statistically normal. They know the system recovers. Most traders skip this step. They find a strategy, try it for 10 trades, and abandon it after a few losses. They have no idea if their strategy actually has an edge because they've never properly tested it. The seven-figure traders I've met spend more time backtesting than live trading, especially when starting out. This is the foundation of everything. The Daily Journal, tracking performance like a business. Every single profitable trader journals. Not sometimes when I remember, not just the big trades. Every single trade, every single day. Their journals include date and time, instrument traded, entry and exit prices, position size, risk-reward ratio, reason for entry, which setup, trade outcome, win-loss, R multiple, emotional state before, during, and after, mistakes made, if any, lessons learned. This is not busy work. This is how they identify patterns in their behavior. They might discover they trade poorly on Mondays, or that they have a higher win rate on certain setups, or that they overtrade when tired. The journal is the feedback loop that drives improvement. Without it, you're trading blind. You have no idea what's actually working, what's not, and why. You're repeating the same mistakes because you're not tracking them. The seven-figure traders review their journals weekly. They look for trends. They adjust. They optimize. They treat trading like a business with measurable KPIs, not like a casino game.
Evening review, closing the loop. After the market closes, the seven-figure traders don't just shut their computers and walk away. They close the loop with a 15 to 30-minute review session. What they review: did I follow my rules today? Most important question. What worked? What didn't? Were there setups I missed? Why? Were there trades I shouldn't have taken? Why did I take them? What can I do better tomorrow? They're not judging themselves on P&L. They're judging themselves on process adherence. A day where they followed all their rules but lost money? That's a successful day. A day where they broke rules but made money? That's a failure, because luck is not a sustainable edge. This daily review compounds over time. Small adjustments repeated daily create massive improvements over months and years. The non-negotiables: sleep, exercise, mental clarity. Here's something most trading books won't tell you. Your brain is your most important asset. Every seven-figure trader I've met prioritizes sleep, 7 to 8 hours minimum. Sleep deprivation destroys decision-making, emotional control, and discipline. Exercise, regular physical activity. Many work out before the market opens. It clears the mind and manages stress. Mental detox. Time away from screens, time away from trading. Hobbies, family, nature. They understand that obsessing over trading 24/7 leads to burnout and poor decisions. Trading is a mental performance sport. You wouldn't expect an athlete to perform at their peak on 4 hours of sleep, junk food, and no physical training. Yet most traders treat their brains worse than athletes treat their bodies. The routine extends beyond trading. It includes the habits that keep your mind sharp, focused, and emotionally stable. The power of consistency. The seven-figure traders I've met all have different strategies. Some are scalpers, some are swing traders. Some trade Forex, others stocks or futures. But they all have the same thing, a consistent routine that they follow religiously. This routine removes uncertainty. It removes decision fatigue. It creates structure in a chaotic environment. It makes trading predictable and boring, which is exactly what you want. Amateur traders seek excitement. Professional traders seek consistency. Build your routine. Write it down. Follow it every single day, regardless of whether you won or lost yesterday. This is what the professionals do. This is what works.
Chapter 4: Execution Without Emotion. The moment of truth. You've done your preparation. You've spotted your setup. The entry is there. The stop is defined. The position size is calculated. This is the moment where most traders fail. They hesitate. They second guess. They enter too early or too late. They move their stop loss because maybe price needs more room. They exit at the first sign of heat because they can't handle the discomfort. The seven-figure traders I've met do something completely different. They execute their plan with zero emotional interference. This is not about being emotionless. It's about having already made all decisions in a rational state, then following through mechanically when it's time to act. Pre-commitment, the predator's weapon. Remember this, emotions are strongest in real time. When money's on the line, when the position is moving against you, when fear and greed are screaming, that is the worst possible time to make decisions. The seven-figure traders know this, so they make all decisions before entering the trade. Before they click buy or sell, they've already committed to exact entry price or specific trigger, exact stop-loss level, non-negotiable, exact position size, calculated, not guessed, exact profit target or exit strategy, maximum time in trade, if applicable. There is no room for improvisation. Once the trade is live, they're simply monitoring whether their thesis plays out or not. They're not managing in the sense of constantly adjusting. They're observing whether to execute their pre-planned exit. This eliminates 95% of emotional decision-making.
Entering with confidence, not hope. There's a massive difference between confidence and hope. Hope sounds like, maybe this will work. I hope it goes my way. Please don't hit my stop. Confidence sounds like, this setup matches my criteria. I've tested this approach over 200 trades. My risk reward is 1 to 3. I'm risking 1.5% of my account. If it wins, great. If it loses, I move to the next trade. Either outcome is fine. The seven-figure traders enter with confidence because they've done the work. They've back-tested. They've proven the edge exists. They know that this specific trade doesn't matter. What matters is executing their system consistently. Hopeful traders are constantly anxious. Confident traders are calm. If you're entering a trade with anxiety, you haven't done enough preparation. Go back to Chapter 3. Managing the trade, the art of doing nothing. Once the trade is live, the seven-figure traders I've met do something that shocks most people. Nothing. They don't micromanage. They don't move stops unless it's trailing in profit. They don't exit early because of bad feelings. They let the trade play out according to the plan. Why? Because they understand.
Micromanagement is fear-based behavior. It's your brain trying to regain control in an inherently uncertain situation. But the market doesn't care about your feelings. Price will either hit your stop or your target. Your interference only increases the chance of exiting at the worst possible moment. Early exits destroy your risk-reward ratio. If you're targeting 1 to 3, but you keep exiting at 1 to 1 just to lock in profit, you've destroyed the mathematical edge of your system. Now you need a much higher win rate to be profitable, and you probably don't have it. The predator doesn't chase the gazelle once the pursuit begins. The predator either catches it or doesn't. There's no middle ground. Your job is to execute the plan, then let probability do its work. Taking losses, the ultimate test of discipline. Here's the hardest truth in trading. You will lose. Often. Even the best systems have losing trades. Even 7-figure traders have losing days, weeks, sometimes months. The difference is in how they respond.
When a trade hits their stop loss, they accept it immediately without emotion, close the trade without hesitation, record it in their journal, and move on to the next opportunity. They don't move the stop loss to give it more room, add to a losing position to average down, hold it hoping for a reversal, or enter a revenge trade to make it back, or question their entire system based on one loss. Taking a loss quickly is not admitting defeat, it's exercising control. You can't control whether the market goes up or down, but you can control how much you lose on any single trade.